What if I told you that keeping too much money in your bank account is one of the most dangerous mistakes you can make with your finances? At first, it sounds safe. After all, banks are supposed to protect your money. But the reality is, leaving large amounts of cash sitting in your account can quietly drain your wealth year after year. The truth is simple. Money that doesn't work ends up shrinking. And while most people feel secure seeing a big balance on their banking app, that safety is often nothing more than an illusion. Let's break down why holding too much cash is actually costing you and how to fix it. 1. Cash is the laziest worker. Think about the effort you put into earning your income. You work long hours, maybe sacrifice weekends, deal with stress, and push yourself every month. Now imagine you've saved $10,000 and deposited it into your bank. A year later, you check back, and it's still the same $10,000. But here's the catch. It's not worth the same. Inflation quietly reduced its purchasing power. Your money didn't grow. It sat idle. And in doing so, it lost value. Now compare that with putting the same $10,000 into investments that earn even a modest 8% annual return. After just 1 year, it becomes $10,800. After 10 years, it grows to more than $21,000, over double your original savings, without you working a single extra hour. The difference is simple. You allowed your money to work for you instead of letting it sit lazily in cash. 2. The emergency fund trap. Of course, some cash is necessary. Everyone needs an emergency fund. But the trap most people fall into is keeping far too much. An emergency fund's purpose is clear: to cover essential living costs if something goes wrong: rent or mortgage, groceries, bills, and minimum debt payments. A good rule of thumb is 3 months of expenses for a basic safety net, 6 months if you want stronger protection, 9 months if your income is unstable. Anything beyond that is just fear money that inflation eats away at. Keeping $30,000 or $50,000 idle in your account doesn't make you safer. It just makes you poorer over time. The smarter move is to park your emergency fund in a high-interest savings account for quick access, but resist the urge to hoard excessive amounts. Once you've set aside the right cushion, every extra dollar should be put to work. 3. The spending illusion. Here's a sneaky psychological trap. The more money you see in your account, the more you feel like you can spend. Imagine logging in and seeing $15,000 sitting there. Suddenly, you feel a little more comfortable splurging. Maybe a new phone, more dinners out, or a spontaneous weekend trip. Your brain interprets that big balance as extra money. But in reality, most of it is probably meant for emergencies or future goals. The illusion of wealth tricks you into unnecessary spending. The solution? Automate your finances. The moment your paycheck hits, move money into investments, savings buckets, or separate accounts. When you don't see it, you're not tempted to spend it. Out of sight, out of mind works wonders in protecting your financial discipline. 4. Insurance limits. Most people forget. Another hidden risk of leaving too much in the bank is insurance protection, or rather, the lack of it. In the US, the FDIC only insures up to $250,000 per person per bank. In the UK, the limit is £85,000. Any money above those amounts is unprotected if the bank fails. This is especially important for people saving for short-term goals, like a home deposit or a car purchase. If you need to hold large sums temporarily, split them across multiple banks to stay within insurance limits. But here's the bigger truth. If you don't need that money for at least 5 years, keeping it in cash is actually riskier than investing it. Inflation will erode its value faster than the bank can protect it. 5. A bigger target for scams. The last danger of oversized bank balances is one most people don't consider: becoming a target. Criminals today use sophisticated tools, voice impersonation, fake groups, even cloned identities, to scam unsuspecting victims. If large amounts of your wealth are sitting in one place, you become a far more appealing target. Diversification isn't just about growing money, it's also about protecting it. By spreading your funds across investments, different accounts, and various assets, you reduce the risk of losing everything to fraud, theft, or even simple banking errors. The takeaway: don't let your money sit idle. When you add it all up, leaving too much money in the bank is one of the biggest mistakes you can make. It feels safe, but it's actually dangerous in several ways. Your money loses value to inflation, you risk overspending, you exceed insurance limits, and you expose yourself to scams. So what should you do instead? Follow 3 simple steps. 1. Calculate your emergency fund, 3 to 6 months of essential expenses, held in a high-interest account for easy access. 2. Separate short-term goals, money you'll need in the next 5 years, house down payment, vacation fund, car purchase, should be kept safe but accessible. 3. Invest for the long term. Everything beyond that belongs in investments. Diversified index funds, retirement accounts, or robo-advisors that let your money grow automatically. Your money should work as hard as you do. Every dollar sitting idle is losing value. value. But the sooner you put it to work, the faster you build real financial freedom. Because at the end of the day, banks are just storage. Wealth is created when your money stops being lazy and starts being productive. If you're ready to stop letting your money sit idle, start today. And while you're here, like this video, subscribe, and hit the bell so you never miss powerful strategies to build real wealth.